Ladies and gentlemen, good day and welcome to AGS Transact Technologies Limited Q1 FY’25 earnings conference call. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involves risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ravi Goyal, Chairman and Managing Director. Thank you, and over to you, sir.
Good morning, everyone. Thank you and a very warm welcome to each one of you for joining our Q1 FY’25 earnings call on behalf of AGS Transact Technologies Limited. With me on this call are Mr. Saurabh Lal, our CFO, our Executive Directors on the board, Mr. Stanley Johnson and Mr. Vinayak Goyal. Vinayak is also the Managing Director of our wholly owned subsidiary India Transact Services Limited. For your reference, we have uploaded the investor presentation and financial results on the corporate website and stock exchanges. We are happy to report a promising performance in Q1 FY’25 and we are confident that we will continue this momentum. In this fiscal year, our focus will remain on improving the growth and the margins of the business, paving the path for upcoming opportunities. Allow me to spend a few minutes here to talk about our strategy. As a part of our strategic growth outlook, we are making conscious efforts to expand our digital payments business. We are also scaling down low margin businesses such as the other automation businesses and moving towards increasing our revenue from services. We have created an asset-light model under our wholly owned digital payment subsidiary, India Transact Services Limited, and will be focusing on expanding our PPI infrastructure through the Ongo card and ecosystem. We will be leveraging our digital payment ecosystem through strategic collaborations contributing to the top line as well as to the bottom line. In the recently concluded quarter, we launched ATM cash withdrawal facility on the Ongo prepaid instrument platform, which will provide the Ongo users a seamless accessibilities to funds across all 2.56 lakhs plus ATM on NPCI network. The Ongo card offers accessibility for corporates, merchants and consumers as it is backed by RuPay platform having acceptance points across India. I am happy to inform you that the pilot of Ongo Fueling, which will be our flagship product under digital business, is near to completion and we expect to launch it in H1 of FY’25. We have onboarded close to 1,300 fleet vehicles in this phase. For added convenience of the consumers, we are testing AI-enabled voice control fueling on the same platform. Ongo Fueling is a niche solution which will be launched on a pan-India basis. The potential for market for fleet fueling is about 1.6 lakh crore on an annual basis. With reference to the issuance of National Common Mobility Card on NCMC, we have issued close to 55,000 NCMCs for Bangalore Metro as of date. These cards can be used for traveling as well as shopping online and in stores. We are targeting to issue about 5 lakh NCMC cards during FY’25 and about 25 lakh NCMC cards over the next 2 to 3 years. Further, the recent RBI mandate has allowed the issuance of NCMC cards without any KYC verifications. These cards have a limit of rupees 3,000 and can be used at various modes of public transport across the country, including metro, bus, toll, parking and water metros. Overall, we see a good opportunity here. There are 7.5 crores closed-loop cards issued by all the metros, which can be converted to NCMC cards over a period of time. Here, I would like to inform you that we are currently in talks with the Metro Corporation to launch no KYC NCMC cards in H1 of this year. According to annual report of Reserve Bank of India, there was a 44% increase in the digital payment transactions from 103.9 billion transactions in FY'23 to 164.4 billion transactions in FY'24. The growth was led by UPI, which had share of 79.7% in the cumulative volume of digital payments in FY'24. The growth in deployments of point of sale, mobile POS terminals, interoperable QR codes, among others, have been aided by the Payment Infrastructure Development Fund, that is PIDF. Overall, the growth of digital payment is significant, which is a healthy sign for the industry, and we are well poised to leverage this growth. We also offer cash management services through our wholly owned subsidiary Secure Values India Limited, which complements our ATM outsourcing business and services. Our cash management requirements for both captive and managed ATMs and contributes nearly 14.2% of the revenue from operations in Q1 of FY'25. During the recently concluded quarter, we have set up a new cash vault facility spread over an area of 14,000 square feet in Bangalore, Karnataka. This state-of-the-art facility will offer world-class cash processing and vault services. The recent demand in ATMs and CRMs, which is underway by H1 of this year, will benefit the cash management business, as there is significant demand for support infrastructure such as cash vaults and logistics. This will further enhance business operations and improve efficiency. As of June 30th, we have installed, maintained or managed a network of approximately 73,034 ATMs and CRMs, and more than 36,200 ATM CRMs were serviced through Secure Value India Limited. Secure Value India accounts for 463 vaults and spoke locations. We have about 745 pickup and doorstep banking points and a network of 2,370 plus secure cash vans across 1,800 plus cities and towns. Lastly, I would like to share that the company has initiated an equity fundraise of rupees 2,000 million, that is 200 crores through preferential allotment. This will help us drive sustainable growth for our business in the long term. Now I would request Stanley Johnson, Executive Director of AGS Transact Technologies, to share the business development highlights. Stanley, over to you.
Good morning, everyone. Let me take you through the business outlook for ATM outsourcing business in Q1 of this year. This has been a key growth area for us. It has traditionally been working on a transaction fee model. In the last quarter, we announced the shift in our focus towards the hybrid fee model. I am happy to share that we have successfully renewed a contract with a leading private sector bank to manage their ATM under outsourcing portfolio. This contract allows a hybrid model which covers a fixed fee and a transaction fee. It will generate additional annual revenue of 300 million while maintaining the existing cost structure, thus improving profitability and margins. Further, to give you an update on the order wins from SBI, the deployment of 1,350 ATMs, which will generate a one-time revenue of 750 million, is on track and will be completed by the H1 of this financial year. Another order win of 2,500 plus ATMs under outsourcing portfolio will begin in the second half of this financial year and is expected to complete by this financial year. The order value is around 11,000 million over 7 years, which will add 1,500 million on an annual basis. Our ATM outsourcing portfolio contributed 54% of our quarterly revenue from operations, and around 6.4% of the top line came from the AMC business. The revenue share from the service stands at 93% in quarter one. The contribution from the service remains healthy, as this income is supported by long-term contracts and is recurrent in nature. The Indian ATM industry is projected to grow at a CAGR of 9.2% between 2024 to 2032. This is due to the growing demand for ATMs and CRMs. As leading banks expand their branches, various RFPs in the range of 18,000 to 20,000 ATMs and CRMs are currently underway in the first half. The demand in the industry provides a significant opportunity to expand potentially, increase the market share and profitability. At AGS Transact, we are well positioned to grab a significant pie of this growth. We have a state-of-the-art infrastructure in Navi Mumbai, which houses a 24/7 monitoring center that helps us in ATM monitoring, cash forecasting, and cash reconciliation for all our ATM service operation. We offer transaction switch platform and fraud detection tool for various clients, a software lab for carrying out various pioneering new initiatives, and we also have a testing and a repairing center to ensure smooth functioning of our products and solutions. Now I would request Saurabh, the CFO of AGS Transact Technologies, to share the financial highlights of quarter one. Saurabh, over to you.
Thank you, Stanley. Good morning, everyone. Now I would like to take you through the financial performance of the company for quarter one FY'25. In quarter one of FY'25, the total income of the group stood at 3,516 million versus 3,794 million in Q1 of FY'24. Going forward, we anticipate an increase in revenue by renegotiation of contracts, new order wins, and execution of those orders, and our digital initiatives. Talking about the EBITDA number, in Q1 of FY'25, the EBITDA margin stood at 29.9% versus 27.1% in Q1 of FY'24. Our EBITDA on absolute terms stood at INR 1,053 million in Q1 of FY'25 versus INR of 934 million in Q4 of FY'24 and INR 1,030 million in Q1 of FY'24. Now I would like to highlight that in quarter one of FY'25, EBITDA represents the reported EBITDA. There are no non-recurring expenses in the said quarter. For the comparison purpose, the EBITDA that I stated above is adjusted EBITDA for Q1 of FY'24 and Q4 of FY'24, as there were some non-recurring charges we have taken in those quarters. Regarding the PAT numbers, we recorded a healthy PAT of 138 million as against the profit of INR 6 million in Q1 of FY'24 and a loss of INR 44 million in Q4 of FY'24. The net debt position of the company stands at 5,857 million as of 30th June 2024. Just to give you a quick update on our subsidiaries' performance in Q1 of FY'25, Secure Value India Limited, which is into business of cash management, reported a top line of INR 1,033 million. It's a gross revenue including AGS with a EBITDA margin of 20%. Its non-AGS business, which is a business coming from non-AGS customer, was close to around 47%. ITSL, which is again our digital subsidiary, which takes care of our acquiring and is going to be the flagship for all the launches in the ongo space on the issuance side. The reported revenue from the operations is INR 334 million with a EBITDA margin of 9%. GTSL, our foreign subsidiary, generated a revenue from operations of INR 194 million with a EBITDA margin of 26%. With this, we conclude our presentations and open the floor for further discussions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. first question is from the line of Ankit Kanodia from Smart Sync Service. Please go ahead.
Thank you for taking my question and congratulations on good profitability and margin. So my first question is related to the numbers. When you look at the revenues, we have seen a degrowth of around 7%. And also the main, as far as my understanding, the main increase in profit has come because of reduction in employee expenses and other expenses. So if you can throw some more color as to why revenue growth has not been there in this quarter and more detail about the employee expense and other expenses, that would be very helpful. That's my first question.
Sure. Thank you, Ankit. Ankit, with respect to the revenue, if you see, over a period of time, the company has moved its focus mostly on the service revenue, and over a period of time, we have keep on reducing our revenue from the product side, and company is increasing more and more revenue on the service revenue, including payment solutions, covering cash, digital, and everything. So from that perspective, even though there may be a reduction in certain revenue streams coming from the various business, we continue to ensure that whatever businesses that were there in the contracts that we have, they should be right contracts and have a right margins for us to grow business from a profitability perspective. So that is one reason there is a reduction in revenue, and this we have consistently telling the markets also and to the stake or everyone that over a period of time our revenue has degrowth. There is a degrowth over a period of time either on the quarterly basis or annual basis also. But at the same time, when we said then we will be reducing the revenue from various businesses like other automation solutions or maybe some contracts on the payment solution also, we have ensured that we should keep on quick tab or cost tab on the cost side also. So we have ensured that certain costs which are directly related to those contracts, directly related to those businesses should be pruned down immediately. Some costs get transferred over a quarter because of the contractual obligations that we have, warranty obligations that we have, or certain costs have I would say, transition impact also. So I think those costs have started coming down, and that is why we have seen certain benefits coming from the cost side. But I would like to highlight that as Stanley also covered in his speech that we have been able to negotiate certain contracts also, which has helped us to have a hybrid model where we got the transaction fee revenue and a fixed revenue, which will have an incremental benefit on of the revenue. And since there is no direct cost associated those revenue, there will be incremental impact on the bottom line, covering the EBITDA and the PBT level also. So I think covering all those factors, even though you have seen there is a degrowth in the revenue by quarter on quarter or on the year-on-year quarter, we have seen the margins profile of the company has significantly improved, both from the AGS standpoint, both from ITS standpoint, or even secure value. On overall basis, the EBITDA margins and the other margins of the company is improving.
Got it. Thank you so much. That was very helpful, sir. So my next question is related to our working capital. So when I see our working capital, our days payable looks very, very, very high. Can you just throw some more light as to how our days payables are so high?
So Ankit, definitely we have seen in the past also that the working capital cycle of the company is consistently high as compared to what the market expect then, and companies consistently making an effort to reduce those markets and working on those numbers that we should reduce this working capital. But considering the nature of business, considering the nature of transaction in which we are and the customers which we deal with, I think though this working capital cycle should come down, and companies making consistent effort to reduce this working capital cycle by prioritizing the billing, prioritizing collections, doing the reconciliations on a constant basis or frequent basis, so that this amount should not get delayed, should not get covered, and should not get affected in the working capital. Having said that, I think we also just covered that we have just executed a SBI order also, which is a VAR order, or I would say banking automation order, where again we have sold the product to the bank and will now collect this money over a period of time. Now this collection will come once the ATM goes cashless and everything. So these are the factors which sometimes elongated our working capital, but I think our company's business, everyone's endeavor is to bring this working capital down and constantly focusing on to ensure that the money whichever is due to us should get collected at the earliest.
Got it, sir. So one last question, if I may. Sir, when we did our IPO, it was completely 100% OFA, and recently we have done a preferential allotment. So, and I see the borrowings continues to remain almost on the same level over the last 2-3 years. So, is it fair to assume that we'll continue with the same borrowing levels and probably use all these funds to for CapEx only? Or are we having any plans to reduce our borrowings also from the current level?
So under from a company's payment plan and everything, I think the borrowings mostly consist on the form of term loans, so which we have been consistently reducing. If you see from a last 1 year perspective, I think the gross borrowing and the net borrowing has come down from a significant number, because most of the borrowings are term loan and they have a fixed horizon and tenure on which we have to repay. And I think in the plan of the company is to definitely become debt free over a period of time in next 3 to 4 years, as we have already communicated last time also. And the money that we're collecting is definitely going to get used for the business purpose, expansion purpose, and maybe for working capital purpose also, as per the defined end use that we have given in our offer letter also. But yes, the company's constant effort is to keep the borrowing at level which is sustainable in the form of EBITDA to net worth, EBITDA to borrowings, and all those ratios in mind.
Thank you so much, sir. I'll come back into the queue if I have more questions. Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Ritika Dua from Bandhan AMC. Please go ahead.
So firstly, on the revenue outlook, which I think has been discussed by the opening speakers. So you mentioned 3 lines. One you said is obviously the hybrid fee model, which will help you maybe add, if I heard them correctly, some 30 CR. So firstly, what is this 30 CR? Is it like, are you saying that this will be on an annual basis, or after that reset for this year you will benefit out of 30 CR? Is that first question. Second question is that, if I heard you correctly, you said that another 150 CR of annual revenue would come on a recurring basis. So that's the second clarification. And thirdly, you said that certain digital initiatives would also help you maybe, improve your revenue. So firstly, if you could clarify on these 3 counts on relating to your revenue, and basis the clarification you provide, how do you think like maybe revenue should pan out in the next, maybe at least in the next 1 year, if not 1 to 2 years? That's my first question.
Sure, Ritika. Thank you, Ritika. Ritika, I'll go one by one. Definitely, as far as Stanley covered here, is that the revenue, which is a hybrid model contract that we have renegotiated with the bank, will help us to have an incremental revenue of 30 crore rupees. So definitely that is an incremental revenue on the annualized basis that will get accrued to us. Second, there is another contract of State Bank of India, which is still not started, right? But yes, we are confident that this will get executed in this quarter and will definitely get closed maybe in 2 to 3 quarters from now. The annualized impact of that revenue will be approximately in the range of 150 crore incremental revenue on the basis of the contract PO and everything that we have received from the bank. So basis that, we assume that we are confident that we will have an incremental revenue 150 crore coming into this business on annualized basis. Third, on the digital initiative side, definitely as we said, we have a very strong plan to execute this new NCMC rollout card. We have a plan to initiate this on-go fuel go live and everything. So all this new initiative will give us an incremental revenue because these revenues were, I would say, negligible in the case of past performance of past quarters and past years. So whatever new issues that we do, whether we do it for NCMC, whether we do for on-go fuel, it will be incremental revenue to the existing top line that we are already accruing or already earning.
Thanks, Saurabh. So just if I could maybe one more clarification. So obviously I got the point that this 30 plus 150, so roughly 180 CR is an annualized number. So assuming that it comes only in the 9 months, so maybe proportionately that is the benefit that we are looking at for this year. And how much of that would actually, so and then that sets in the base. So then we should look at a stable run rate, or how does it really work? Should at least at best this number continue in the next year, and there could be a growth over it also. So if you could just maybe help something on the future as well on these 2 accounts, because these are large numbers. You're saying 30 plus 150, 180 CR proportionately, even if it's for 9 months, it's a good number.
Correct. So, Ritika, on the 150 crore, definitely it's an annualized number. So automatically, and as I said, Ravi also mentioned, it's a 7-year contract. So we continue to earn that revenue for a period of 7 years, depending on the actual transaction that will happen. 150 is the average number that we assumed over the period of annualized basis, translating around 1100 crore of revenue accruing in next 7 years. Second part, as I said, but yes, for this year, there is a possibility that this full revenue will not come. But yes, on an annual basis, when this contract get executed fully, 2,500 ATMs, this is what we believe that this is an additional revenue that will get accrued on an annual basis to us.
And so sorry for this because I am obviously a little new to understanding the entity. Your annualized revenues, if I see the historical numbers, you were at about peakish number of 1,700 crores. And now you're looking to add 1,100 crore via just one particular contract. So
that is for 7 years, Ritika. That is for 7 years.
No, I understand that, sir. I understand that. But still, I mean, if I see that if this is not a very new business that we are entering into or something, a new category, we would have done this ATM outsourcing business, I think, in the past also. Maybe I don't know if the quantum is so large or something that, or in the past also, whenever you have received orders to this extent, because, these are all new and rolling contracts. Has the revenue potential been so huge over a 7 years? I mean, have you seen in the past also?
So it depends on the size and the number also, but since this is a significant order and a significant number of ATMs, that is why this is a huge number. Otherwise, in case of normal growth, the normal incremental revenue that we keep on earning from the existing contracts, the quantum may not be that huge. But yes, since it's a single PO of 2,500 plus ATM, this become a significant order of 1,100 crore.
Fair, sir. Okay, maybe sir, on the second question that I have is on the OPEX bit, I think, which somebody else was also trying to understand on the call. But if you could just still guide some bit more here, and when I just see the numbers, the employee OPEX number bit was roughly a 46 CR moved to 54 CR. So is it maybe because of some maybe payouts, annual payouts, and then the other expenses were moved down from 190 to 164? So that's also some 30 CR of reduction in other OPEX. And you are saying that incremental revenue addition in this piece is also 30 CR. So I'm not trying to put both together, but if you could just maybe help us explain this a little bit more.
Sure. So on the expense front, definitely from the employee side, yes, there were some annual payouts which has an impact in the quarter one, and which is not on the annualized basis. This will have an impact in quarter one, and to some extent will have some impact in quarter two also, and then it will automatically goes down. From the other expenses perspective, if you see in the last previous quarters, there were certain write-offs that we have taken, one-off write-offs, and there are certain commitment fee P&L charge that we have taken. So since both majority of both the charge are not significant there in this quarter, so there is a significant reduction in those two costs. Plus, there are other savings also as some revenues has trimmed over a period of time, so automatically certain other costs associated with those revenues has also got trimmed. So those were the reasons for the cost reduction specifically.
Okay, so just to maybe clarify this, so this 190 crore had the 36 crore non-recurring in it.
Yeah, if you're comparing with the last quarter, yes.
Yes, okay. So actually from a 190 crore minus 36 or roughly say 30, so it's actually flat 160 on a sequential basis then. The other OPEX is what you're trying to say.
I don't have the exact number, but yes, that is what the major reason is there.
Okay, so and just maybe some guidance here too, sir, would help that, how do you look at this number, like you said in the opening remarks that a lot of one-offs are done with now. How should this number move incrementally?
So from a business perspective, there are certain direct costs, Ritika, that will continue, so that will go as a percentage of revenue. Other than non-recurring expenses or one-off items, definitely we as a management and a company trying to ensure that we should recover all the money that we have billed to the customer, and this impact is to the minimum, or whatever impact is that is taken as a cost of doing business, which is a normal recurring expense to the company perspective. So that is what we. So the cost will continue in the form of in the ratio of revenue, except those one-off items. If you can exclude those one-off items, then you will be able to definitely do a, I would say, percentage linking to either payment solution business or from a outsourcing business. Or in case Ritika, you need more detail, we can definitely do this offline discussion, and we can give you more details how the segmental revenue, or you can look at the segmental revenues and segmental cost and make out the percentage of EBITDA or gross margin that we generate on every business on business.
Sure, sir. I'll definitely do that. Just maybe two more questions, if I may.
Yeah, please go ahead, Ritika.
Yeah. So secondly, on the depreciation, what is that you have to maybe guide here? And that is one question. And secondly, second question is that you said that the preferential is not necessarily to pay down the debt, because the debt is on a term loan structure and it has a fixed obligation, etc. So how do you look to utilize the 200 CR preferential? So two questions, yeah.
So on the depreciation side, Ritika, mostly the depreciation is in the form of the assets that we have deployed, that is ATMs and other sites assets and the ROU assets. Most of the depreciation is on those fronts. Second, on the preferential issue side, I think the 200 crore rupees of capital that will get infused in the company from the current use, we have kept it that some percentage will go for a debt reduction, some debt repayments, some percentage will go for the company's working capital business purpose, and the certain percent has been kept as a GCP purpose. So I think covering all these things together, we have some flexibility to use this capital, and with the current business plan in hand, with the current strategy in hand, I think this capital will be applied as per the internal approved plans or as per the board approved guidelines.
Lastly, how should we model the tax rate now going forward?
Tax
for
rate.
FY'25?
So tax rate, that will be a normal Indian entity, since we have most of the revenue coming from Indian entities, so tax rate will be approximately same tax rate, except for few benefits that we get because of carry forward losses that we have. Otherwise, from a ETR perspective, the effective tax rate will remain same.
And what is that, if you don't mind?
So it's approximately 25 to 26%.
So that is the number we should model in.
Yeah.
Only. Okay. Thank you. I'm done.
Thank you, Ritika.
Thank you. The next question is from the line of Rishikesh from Robo Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. So my first question is that there was a request from industry for a rate increase to RBI from 17 rupees to 21 rupees for ATM transactions. So if you could please comment the status for the same.
So there has been, this is Stanley here, there has been representation by the industry on the increase of interchange. We have just learned that there is a subcommittee formed to review that across both at RBI and IBA level. So I think we should hear shortly on the review of the new interchange rates.
Okay. So regarding our revenues, how much proportion of our revenues come from transaction-based ATM?
Rishikesh, Saurabh this side. So since our contracts are with the bank directly, so in some of the contracts our revenues are linked to interchange, but in most of the contracts it is already a pre-negotiated rate per transaction that we have with the customers or with the banks.
So the 4 rupees, in case it has to increase by 4 rupees, it would not impact positively on our EBITDA number?
Not really. In one of the, or I would say couple of contracts, definitely it will benefit, but not for all contracts. Mostly in industry, whoever are the player like us who are basically brown labor players, since they have bilaterally negotiated this contract with the banks, the rates are already agreed in the form of offers transaction and honors transactions. Some of the contracts have the flexibility which has an interchange linked rate on upside and everything. That benefit will come to us and to other also. But otherwise, this interchange impact will definitely go to the issuer on the first side, and definitely issuer shares those forms of additional revenues with us in the form of compensating other revenues, but not directly.
Yeah.
So the major gainer of the interchange revenue would be the acquirer banks, and because of the increase of the interchange, you will see deployments happening more across. So more number of ATMs would come under the outsource model as you see the interchange rates going on.
Okay. Also, I have a question regarding our POS segment. So, if you could let me know what is our revenue for Q1 in POS?
Sorry, which segment? POS. So the POS segment revenue is approximately around 334 million.
Okay. And regarding POS, our GTV growth looks flat for last few quarters as well. So if you could put some light here as well, and how do we see the GTV growth going ahead?
So, Rishikesh, definitely on the GTV side, as we said, the acquiring business we continue to do with mostly with the oil marketing companies. So wherever the POS has been installed, we're trying to cover up to get to the maximum revenue on the POS side. But at the same time, we are putting more team and efforts right now to set up our issuance base also. So I think on a strategy of the POS side, I think we have deployed most of the POS terminals at the oil marketing companies wherever we see the profitabilities and wherever we see the revenue numbers are okay. And the last few quarters, you must have seen that we have not deployed any major POS in this segment also, and we continue to generate the revenue from the existing POS deployment that we have. So from a perspective of growth, I think the more from the ITSL perspective, I think mostly the revenue and other things where we are putting focus is on the issuance side, and the POS will continue to give us the existing revenue run rate and everything, and definitely it will help us to continue our harness our relationships with all these retail outlets and other things where we can do certain other business combinations and other business deals and business transactions.
Do you have any internal, target of how do we look the POS revenues to grow going ahead in FY'25 and FY'26?
Yes, we have a plan. So I think, as I said, most of the POS revenue comes from the oil marketing companies and our corporate customers. So internally, definitely as a team, we keep on growing that numbers on certain percentage basis. This is how the POS network will grow from the acquiring side, from the oil marketing companies, and from the corporate deployment, whether to the organized retailer or through tie with the banks. So these are the two channels where we are expanding. On the retail side, I think as a management, we have taken a stand that it is very difficult to grow that retail side business, and we'll keep on continue to put focus mostly on the oil marketing companies or on the organized retail.
Okay. And also regarding ATM revenues, the 180 crores additional annualized revenues that we are talking about by deployment of new ATMs, this is over and above what run rate we are doing currently, right?
So out of this, the price increase has already been incorporated into the quarter one, yes. But for that additional 150 crore, yes, it will be over and above.
Okay. And just last question, do we expect our Q1 EBITDA margins to sustain going forward?
So, Rishikesh, definitely, yes, the target is to ensure that we continue to sustain, yes, but over a period of time.
Okay. Thank you very much, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Rahul Mehta from JM Financial. Please go ahead. Hello, Mr. Rahul. Your line has been unmuted. Please go ahead with your question. Mr. Rahul, your line has been unmuted. Please go ahead with your question. We will move on to the next question. It's from the line of Tushar Sartha from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. So I wanted to understand this renegotiation inside of the ATM charges. So is it happening for all your ATMs or only for some? And what is the total impact going to be? Is it going to be 150 crore per annum, or as more negotiation happens, we will have more revenues coming in?
So specifically, what right now we have updated to everyone is that we have negotiated this rate increase with one of the bank right now that we have in our portfolio, and that benefit is in the form of around 30 crore rupees of incremental revenue that will go towards. The 150 crore rupees is a new contract deployment with State Bank of India that will, once get deployed, that benefit will come to the company over a period of time. And on the annualized basis, we see there is a potential of increasing our revenue by 150 crore once all these ATM get deployed.
So this 150 crore is new revenue, new ATMs?
Yes, new revenue.
New associated costs. It's not incremental revenue in that.
It's not the negotiable cost. It's a new contract, yes.
Okay. And this 30 crore covers how many ATMs?
It's a pool of more than 6,000 ATMs.
6,000 ATMs. Okay. So any more renegotiation you think which will benefit your revenue?
So there are a lot of discussions going on, sir, but still not finalized.
Okay. Okay. And what is the difference between this fixed fee and hybrid? If you can throw some light on the commercials.
Difficult to sort of give you the detail on the exact commercials, but yes, on the hybrid side, sir, the ATM gives us the opportunity that we can earn the fixed fee to cover up our fixed costs and everything, and at the same point of time, we get benefited for every transaction that happens on the ATM. So that gives us the hybrid model. Under the full fixed fee model, we only get opportunity to earn a fixed fee on the ATMs or on the CRMs, but no incremental revenue or no extra revenue coming if in case there is a high transaction on those machines.
Okay. Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Hello.
Hi. Hi, Vignesh.
Hi. Sir, actually, I wanted to understand the on-go card business that you highlighted in the beginning that it's going to be used at the metros and pilot stages is going on. So what sort of revenue do we expect there? And can you explain us the model? Is it on transaction fee and, or how does it work?
Sure, Vignesh. Vignesh, on the on-go platforms, so as I said, issuance platforms, so we will be issuing the prepaid cards to the various consumers, maybe like you and me, or to the various corporate fleet operators in case of on-go fuels. In case of NCMC card, it will be given to all the commuters who travel on the metros or maybe for transit purpose, because there is a defined end use for a NCMC card. It can be used on transit, it can be used on platform, it can be used on parking, and another on the train, on the bus, and all those things. So the revenue will come in the form of the interchange fees. In case of NCMC, there is a rate fixed by the regulator, which is around 0.58% of the transaction value. In case of fueling, when we issue an on-go fuel card, we have negotiated the price with the oil marketing companies, like they give it to the all other partners they have. So they will give us those percentage of revenues. Again, it is a percentage of revenue of the volumes. So in whatever volumes, whether we do the issuance, all our revenues are linked to the total volume that we bring on the table for the companies, maybe for the transit companies, or maybe for the oil marketing companies. So our revenue stream will be percentage linked to the total volume that our platform will bring on the table for the oil marketing companies, for the platforms, for the transit, or any other business. And these interchange rates varies from every transaction to transaction. In case you do for fueling, it can be anywhere between 0.4 to 0.5. In case of a transit, as I said, it's 0.58. In case of offline sale and purchase by you or me, it can go up to as high as 1.3, 1.4% of net interchange to us.
Okay. So these are prepaid cards?
Yeah, these are prepaid cards. Yes, these are prepaid cards.
So where do you see the maximum potential? Because I think everything else, fueling and all, is not, seeing that much traction. So where do you see the maximum, potential for these cards being used in the metros, for transport, or anything else?
So we see a good opportunity both in transit and good opportunity in case of fueling also. Our product, which is on-go fuel, which is right now running at the pilot stage with one of the oil marketing company, is going to be a flagship for us. We have tested this product in the past also, and we are right now also piloting in Mumbai area. And basis that product feedback that we got, the corporates that you are using the product, which has a very, very unique features of preset. You can sit in your office, get your vehicle fueled and filled. Your family can fuel it by you sitting here. It's a cardless, cashless device-based system where you can just upload your transactions on the app and immediately make the fueling as a hassle-free fueling without making any payments and everything. And it has a lot of other benefits in the form of preset of the fuel station, preset of the nozzle. The nozzle cannot move out of the fuel tank unless and until the complete fueling process has been completed or not. So there are a lot of other benefits attached to this. I think this product going to be our flagship product, which is from where we believe that the maximum revenue will come. And at the same time, we have already launched our prepaid card in the partnership with Bangalore Metro and RBL Bank, where we are issuing these prepaid cards. We have already issued up to 55,000 cards up till now, and we're targeting to take this number to 5 lakh cards in next few in this year itself. So I think these are the two main products that will add up to our majority of the revenue in case of issuance is concerned, or Ongo platform.
Okay. So the Ongo platform Q1 revenue is 65 crores, correct?
So Ongo platform, the Q1 revenue is 65, but in that portion, the Ongo revenue will be less. Most of the revenue has come from acquiring, transit, and other solutions.
Okay. Okay. And what is the margin in this business? Approximate?
As of now, Vignesh, definitely the ITSL is working on a EBITDA margin of around, I would say 9 to 10%. But as we scale up, as we grow the business, the volume grows, since the fixed costs are almost same as we grow, I think the margin will grow. So very difficult to give you the exact margin, but I think that the rate at the price at which we're going to negotiate the contract, I think it will have a significant margin to us.
Okay. Okay, then I'll get back in with you. Thank you.
Sure.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity again. Since your business model is undergoing a change, you're moving to more service-oriented thing. Do you have any guidance for next 1 or 2 years with which we can work in terms of revenues and EBITDA and net profit?
So, Tushar, as of now, definitely it's very difficult to give the exact guidance on everything, but as we said, the business is, I will not say it is pivoting, but yes, it is transitioning from a only ATM operator to a integrated operator from ATM and digital transactions and digital business, with the very focused approach on growing the digital business on the issuance side. But at the same time, ATMs and cash continue to be a big business growth for us. I think since ATM and cash continues to grow, ATM and cash continue to be our priority sector, that will keep on growing and adding as per the market dynamics. But yes, digital business, where our presence on the issuance side is very negligible at this point in time, very small at this point of time. As it grows, as it moves forward, this will add a significant base to our top line, and it will also add to significant base to our bottom line also. So very difficult to give you the exact guidelines, but I think the growth will be seen in the numbers over a period of time.
Okay. Thank you.
Thank you, Tushar.
Thank you. Ladies and gentlemen, that was the last question for today's conference call. I would now like to hand the conference over to the management for their closing comments.
Thank you all once again for joining us on this call. Before we sign out, I would like quickly summarize our outlook for FY'25. Our near-term objective is to grow and scale the digital business by building an open-loop PPI infrastructure through the issuance of cards and wallets. We will continue to strengthen our ATM outsourcing business, our cash business, and focus on increasing revenue share from our services. Thank you so much.
Thank you, everyone.
On behalf of AGS Transact Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.